Yo, what's going on? Welcome back to Film and Key. And today, I know it's been long awaited. A lot of you guys have requested this, so I had to do it. But it's as of March 19th today, or is it the 18th? Let me check. It is the 19th. Today, we're going to do the dividend income and closed-end fund report. I know it's been a bit, it's a little late, so let's get straight into it. But I've got great news for all you guys and an overview of the last play we did. So first of all, I wanted to highlight the positions that we did have beforehand, some of which have done very well over the past year. Obviously, if you guys have been in a lot of growth stocks, you know that growth stocks have taken off this year in an unprecedented amount, like crazy amount. But looking at these funds that we have here, the first one is Pimco Corporate and Income Opportunity Fund with a yield of 8.69, and it's paid monthly. So with this, we were able to get a return on the principal of about 11.94%. That would be the capital return, but not the dividend return. So the dividend actually I had collected the whole time. So if you're looking at these funds to invest, they're really good opportunity just because, like I just mentioned, 11.9% on top of getting paid 8.69% is an insane amount. So, the second one would be CHW, which is 19.2%. $3,900 profit. This one's also a great one. As you can see, we're up about 20% on top of 8%. So the actual return would be 28% for the year. Or actually, no, yeah, for the year. And an 8.3% dividend yield paid monthly. And RQI, which is, we're up 16.77%. For those of you that had invested when I'd first put these out on the channel or in the group, you guys would have seen this. So $4,100 profit. 7.15% dividend yield. I like RQI the most, actually, out of most of these. Not because of the highest return, but over the last 10 to 20 years, it's consistently beat the S&P by like a significant amount. Like both of these either mirror the S&P or beat it, or they're a little bit less, but they give you the access to liquidity, which most stocks do not, because they're paying you that dividend, so you don't have to necessarily pull out your principal. But yeah, that's why I do like RQI. I had done a comparison between RQI and the S&P, and it was about 60,000 over 10 years versus the S&P, which returned 42 was it 38 over 10 years. I'll have to put that next time, but show that to you. But yeah, those are the three positions I wanted to go over. Those are the highest ones. I have some others, but if I had put them all in a video, this entire video would be like 2 hours long if I'd gone over every single position that I had, or maybe even 5 hours long. But yeah, so first I want to get back into PTY. For those of you that are not already in this and you want to get into it, you guys are probably going to ask, like, should I buy? Like, what is it looking like? So if we look at the technical analysis of the stock, we see that the RSI is 56.7. So it's still a safe play, but you should buy it with caution just because of the way CEFs are structured and how they utilize leverage. But we can see that the market cap is about $2 billion. So you're not going to be in a bad spot with that. It's a very high, what is it called? Market cap. Yeah, very high market cap fund. So you'll be fine. But yeah, like the reason I do say be with caution is because when you look at CEFs, a lot of them have a net asset value, and this stock is trading at about 20 to 30% above its net asset value. That's because a lot of the debt is very desirable by fixed income investors, but at the same time, it is a 20% premium. So just keep that in mind if like the stock did crash and it went back to net asset value. But with a lot of funds like this, you have to look at whether or not they've been trading at a premium or a discount to their net asset value over the last 10 to 20 years. And this one's consistently been at a premium. So I don't know if the premium is that much of a turnoff, but you know, it is what it is. Looking at the distributions for the last pretty much like 8 months, we can see there's no return of capital. So every single distribution is coming directly from the debt and fixed income securities that this fund holds, which is amazing because if you see a fund like this that's CEF with no ROC, it's a huge, like, it's awesome. But yeah, so if you guys want to take a position, like I said, be careful, watch it, see what happens, look for opportunities to buy in. Don't just pile in with lump sums, but keep it on your watch list. The second play, CHW, it's like I said earlier, a safe play, but you should still buy with caution just because of how this fund is kind of going on right now. If you guys look at the distributions, you'll see that there is also no return of capital, which is really nice, but they were at least returning like 10-15% as capital gains, which is still fine because it's not return of capital. They're not giving you back your own money. But the reason I am a fan of this fund is because of a lot of the debt that they hold that I've put on the right. Since these are all corporate debt notes, you can see there's Taiwan Semiconductor, Alcon, Tencent, Amazon, Microsoft, Apple, options on the S&PDR. It's just a fund of S&P 500, an ETF, Bank of America, Keynes, and Aptiv. These are all good companies with very good balance sheets, so they should be able to pay back their debt obligations to Cohen and Steers, which is the company that owns this fund. The reason I did say buy with caution with this one as well is because the RSI is reaching that overbought level to where you'd want to be a little bit cautious to whether you want to buy it or not. But at the same time, if you're going to do it, it's not a bad play. As you can see, there's still a lot of remaining upside if it were to reach the 2007, 2008 levels. But we all know what happened in 2008. So it is at an all-time high in the last 10 years. So just keep that in mind. But then again, a lot of growth stocks and stocks in general are all-time highs. So could be a good thing showing that it's growth. Could also be a bad thing. It's just all relative. And the third one, my favorite, RQI. It's good because there's a lot of upside. So it's a very safe play because you can see the RSI is 56.3. It's like mid. It's reaching upper levels, but looking at the price levels in the last 5 years, you can see that there's still remaining upside to reach the levels prior to the COVID crash. And as I was telling you guys earlier about how it beats the S&P 500 by about 18,000 on 10,000 invested over 10 years. That was really important and something that really stood out to me with this fund. But yeah, the other thing I wanted to highlight with all of these CEFs is even if you take smaller positions right now, with any dips that CEFs have, like the big dip we'd seen prior COVID, a lot of individuals within like different CEF groups and mutual fund groups had scooped up 30 to 40% yields on their money, which isn't insane. So if you had, for example, had $100,000 and you had bought in to CLM, which is a high ROC fund, you would have made, right now it's paying about 14%, but at the lowest you would have been able to secure a 38.2% dividend on your money. So it's just a lot of these CEFs are also, it's important to look out for opportunities like that. Obviously now you're not going to get an opportunity like that, but anyway, I did want to just highlight that and tell you guys that if its CEF yield goes up, that means the stock's going down. And if the stock goes down a lot, it means you could secure a good yield. But you always want to look at the underlying reason as to why that yield has gone up and why that stock has crashed. If it's with the market, then that's fine. But if it's with that exact fund, you're going to want to know. But yeah, if we're looking at this dividend, you can see also consistent for the last 10 years. All CEFs that I've picked that I put in groups that I put on the channel was just all like good CEFs because like I have like vetted every single one of them. Again, I'm not a financial advisor, so you should do your own research, but I vetted every single one of them, looking at technicals, looking at distribution rates, looking at distributions to make sure they're not doing all ROC over a long period of time. And this one has some ROC, but you can see a lot of it's just income and capital gains, so it's not that big of a red flag. Yeah, and ignore the right one. Those are not the holdings of that. This is a real estate CEF, so I'll have to replace that post-editing, but yeah. And if you guys remember the Oxford play from the last video, you guys are going to remember that Oxford Square Capital was about 285 when we'd first put it on. If you had bought in within that 4 to 5 month period from when we'd put it on the channel, you would have locked in about a 20% or 16, 17% dividend yield, gotten that dividend throughout those months, and also gotten 44% on your principal. So like I said, this was a medium risk to high risk play, but if you had done it and you'd believed in Oxford Square Capital, and basically a lot of they're also CEF, but like a lot of their debt obligations, and you'd stayed in this play, you would have made 44% from when I'd first mentioned it. So that's just food for thought. I don't have any new plays as of now, but in the next couple of weeks, I might have a couple of plays that I'm looking at right now and analyzing to see where the next move is as far as like CEFs with a lot of percentage upside. But yeah, and then this is going to be the portfolio income for as of, what is it again, is it the 18th or 19th? It is the 19th. So as of the 19th, as you can see, we're up about 600 from where we were at before, which is great. Like I always tell you guys, just turn the drip on if you guys can, or if you're like me, and you used to have drip on, but now you're like, I don't really know, you could take those dividends and then pick different CEFs that you want to invest, whichever one has the best opportunity at that moment. But yeah, hope you guys enjoyed the video. Like and subscribe, it helps a lot. I'm trying to build like the best community for stocks that are CEFs and mutual funds, because a lot of people just want to do tech, but like, as you know, if that floats your boat, you can do it. But tech is great, but it doesn't have a lot of the safety and longevity of like CEFs, and the history of distributions. But that's just me. I'm also in tech too. I wouldn't tell you not to do it, but it's your choice. But hope you guys enjoy. Hope you guys like the video. Comment if you guys have any thoughts, and subscribe for any more. Peace out.